Okay, we are good now. All right, so let's move on. The next topic is group structure. So this group structure is basically in according to IFRS 3, right? Business combination. So group structure basically talks about how you combine two different companies together, the techniques involved in consolidation. So that is exactly what group structure is all about. Okay, so how you consolidate two or more entities together. That is what group structure is all about. All right, so we're going to discuss that in details now. So let's move on. So let's quickly look at some of the terminologies. The first one I'll be running you through is non-controlling interest. Non-controlling interest. What is non-controlling interest? Basically, non-controlling interest is part of the shares of the subsidiary that is not attributable to the parent. E.g., if a parent acquires 60% in subsidiary, if a parent acquires 60% in subsidiary, then the balance 40% is known as a non-controlling interest. The balance 40% is known as the non-controlling interest. If a parent acquires 60% in a subsidiary, then the balance 40% is known as a non-controlling interest. So non-controlling interest is part of the equity of the subsidiary that is not acquired by the parent. So that is basically what it's all about. Now, there are four various types of subsidiary. The first one is a direct subsidiary, which is known as a simple group. You have done this one before in your skill level. I'll still run you through it, each of them. Then the second one is known as indirect subsidiary, right? The third one is fellow subsidiaries. That is when two or more subsidiaries are under the control of the same parent. And the last one is known as the joint subsidiary. So let's take each of these cases one after the other. In fact, that's the major work we have under our group structure. So let's take each of them one after the other now. All right, so first one we will be starting with is a direct. What's this one? Okay, the first one we'll be discussing is a direct subsidiary. So what is a direct? What is a direct subsidiary? So this is a subsidiary that is directly under the control of the parent, right? That is direct subsidiary. The subsidiary that is directly under the control of the parent. So examples of direct subsidiary. Example, okay? Example is H acquired. H is our parent, or let's H is our holding company or parent. Acquire 80% of the investment in X. So this is an example. So in this case now, H acquire 80% of the investment in X. So this is what you have. So this is what you have. You have your H. You have your H, right? Acquiring X, which is 80%. So then the NCI is 20. So this is an example of a direct subsidiary. So under direct subsidiary, there is one parent and one subsidiaries. Under direct subsidiary, there is one parent and one subsidiary. So this is what direct subsidiary is all about. So the second one is fellow subsidiary. Fellow subsidiary. So this is when, so under the fellow subsidiaries now, this is when two or more subsidiaries are under the control of the same parent. Okay, that is what fellow subsidiary is. When two or more subsidiaries are under. Hey, why are these people playing with the horn now? Sorry, let me check with them. They're just playing with the car horn outside. All right, sorry, it's my daughter playing with the car horn. All right, so that's fellow subsidiaries now. I said when two or more subsidiaries are under the control of the same parent, when two or more subsidiaries are under, oh my God. When two or more subsidiaries are under the control of the same parent, that is what fellow subsidiary is all about. So examples of fellow subsidiaries is H acquired 80% of X1 and also acquires 70% of S2. All right, so this is what fellow is all about. So let's have this now in practical terms now. So I said H acquired 80% in X1 and 70% of S2. So look at these scenarios now. You have H, okay? In X1, he acquired 80, then same H now. In S2, acquired 70%. So this is what fellow subsidiary is all about. You can see that the same parents have two or more subsidiaries, right? That's fellow. Then the third one is indirect or subsidiary. Okay. So all that is, this is when a subsidiary, this is when an indirect or subsidiary comes under the control of the parent through the parent direct subsidiary, right? So this is it. Let me explain this for you now. Let me explain this better now. So you have example. Example is this. So we have H in X1. Just hold on, please. Yeah, okay. So I'll give you an example that we have H in X1, let's say 80%. Then you now have X1 in X2. You now have X1 in X2. Let's say this one is 70%, for example now. So we have this scenario. Who is on mute here? Someone is on mute? Now, Daniel, let me mute you back. All right, done. Okay, so let's assume that we have these scenarios now. So if we are to interpret this now, how are we going to interpret it now? So the interpretation will look like this. It will look like this. You have H. H in X1 is how much? 80. Then you now have X1 in X2, which is what? 70. So this is an example of indirect subsidiaries. Do you know why it is called indirect or subsidiary? It is simply because H owns X1, then X1 owns S2. So because H is the owner of X1, H has a controlling interest in X1. So anything X1 is doing, H is entitled to up to what? 80% of it now. So if you want to calculate the effective control now between, if you want to calculate the effective control between H1 and S2, you will now multiply 80% that H owns in S2, multiply it by what X1 owns in X1. So if you do 80 by 70, remember that H owns 80% in X1, right? X1 now owns 70% in S2. So what H H own is X1 is 80. So any business that S1 is doing, H is entitled to how many percent? 80% of that investment. So we can actually say that if you want to know the indirect holding that H has in S2, it's going to be 80% of what is in X1 multiplied by what X1 owns in what S2. So what is 80 times 70, everybody? Please give me the answer.
56,600.
That's 56%. So H in S2 indirectly now is 56%. So your new group structure will look exactly like this now. Your new group structure. So you have your H, okay? You have your H like this, right? X1 is 8, then S2 is 56. So this is exactly what you do whenever you have this type of indirect holding. Okay, whenever you have indirect holding, this is exactly what you do. Please, is this clear to everybody? Let me take your feedback. I know students normally have problem when it's come to Please, do you have any questions for me? Question.
Sir, please do it again.
Oh, should analyze it again. Okay. Where exactly is my phone? All right, let me analyze it again for you. Okay, good. My network strength is low. Just let me check. I think I left my phone outside when I went. Let me bring my phone back because my network is very low. I'm using the Wi-Fi hotspot on the phone. Just a minute. All right, sorry, I'm back. It's actually my daughter that had the phone. Okay, so let me reanalyze these things for you again. In fact, whatever I have here, I will clean it. So whatever I've done here, I will clean it so we can restart it again. All right, so we have, so like I said, that indirect subsidiary, this is when a subsidiary comes under the control of, this is when an indirect or sub-subsidiary comes under the control of the parent through the parent direct subsidiaries. So that's exactly what indirect subsidiary is all about. So I said that we have an H in X1. Remember that the parent is H, right? It owns 80% in X1. Then X1 now owns 70% in S2, right? X1 owns 70% in S2. So if we want to analyze this now, please listen carefully. We have our H here, the parent, right? It owns X1 he owns 80% in X1, right? Then X1 in X2, he owns 70. Correct. So this is exactly what happened in this case now. H in X1 is 80 and X1 in S2 is what? Is 70. So, and I said that in this case now, if you want to know the indirect holding between H and S2, if you want to know the indirect holding between H and X2, in this case now, all you need to do is to first of all check how many percent does H own in X1. Remember that H own 80% in X1, right? Then for X1 now owns 70% in S2. So if you want to know direct holding between H and S2, all you have to do is to multiply the percentage owned by H, okay, in X1 by what X1 owns in X2, by what X1 owns in what? In X2. That is exactly what you need to do. So you multiply that by what X1 owns in X2. So in this case now, what X1 owns in S2 is 70%. So H will be entitled to 80% of what of what X1 owns in S2. So which is 80 by 70. That gives us what? 56. Okay, 56. And whenever you are working on subsidiary, you must convert the groups. The first thing you do is to convert the group structure to fellow, to fellow, to fellow, right? How do you do that now? You convert the group structures to fellow. So how do you do that? So basically, so what it means is that what we H own in X1 is 80. What 80, then what H will now own in is 80 of what 70, which gives us 56. So that is exactly what you do under indirect subsidiary. I don't know if this analysis is much better now. Before I move on to the third one, please. We still have other more principle to discuss under the third one. Is this analysis clear to everyone, please, before I move on to the third one?
Sir.
It's clear. Thank you so much. So this is how you treat your indirect or subsidiary. The third one is the most difficult aspect. That is known as your joint or mixed group. Okay. The third one is joint or mixed groups. That's the most difficult aspect. Joint or mixed group. So under joint or mixed group now, there you have the presence of, there is the presence of both direct subsidiaries, okay? There is presence of indirect subsidiary, and there is presence of fellow. So under this group arrangement, there exists a direct subsidiary, okay, fellow subsidiary, and sub or indirect subsidiary. So this is like when you where you have like an assorted something, it combines everything. That's why it is called joint or mixed group. It's the most difficult part of the group structure analysis. So I would spend a lot of time to explain this now. Let's take these examples. So we have H in X1, okay? H own 80% in X1. Then H also owns 30% in S2. Then X1 now owns, let's say, he owns 40% in S2. So this is what we have. Oh yeah, let's analyze this now. Okay, let's analyze this. Let's analyze this together. Let us analyze. So what do we have now? We have, go up a little bit. So we have the parent H in X1, right? He owns 80. Then H also in X2, he owns 30. Then we now have X1 in S2. 40. Right. This is exactly what we have here. All right. This is what we have. So there are a lot of confusions here. Do you know the confusion? The number one confusion is that if I remove this line, okay, if I remove H in S2, what we have is indirect subsidiary, right? We only have, suppose I remove this H in S2 30% completely now. What you'll be seeing is just like L, that is indirect subsidiary, correct? Then if I remove S1 in S2 40%, what we'll be having is what? Is fellow, that is H in S1 and H in S2, right? Then if I remove those 40%, and this 30% too, you will only be having H in S1, which is direct. So you discover that every form of group structure exists in this diagram. So how do you now consolidate? So the first thing you do is convert the group structure to fellow subsidiary. So that's what you do. Who is at the gate that want to join the class? So the first thing you do is to convert the group structures to fellow subsidiary, right? That's what you do. You convert the group structures to fellow subsidiary. So how do we do that now? First, we know that H in X1 is 80%. Then H in S2, we have direct. H in S2, the H in S2 is grouped into two. You know, for H in S2, you have both the direct acquisition and you also have the indirect acquisition, right? Direct acquisition is this H in S2, which is 30%, correct? So direct acquisition is 30% here. That is the H in S2 is your direct acquisition here, 30%. Whereas the indirect acquisition, who can give me what is the indirect acquisition for H in S2? I need answer, please, fast. What is the indirect acquisition for H in S2? You said 30 what?
Is it H in S2? Everything
The
will be
indirect.
62.
H in S2, what is the indirect acquisition for H in S2, please? That's what I need.
32.
32%.
How did you arrive at 32%?
80% of 40%.
Okay, that is 80% is what H own in S1, right?
Yes.
So you just multiply it by what X1 owes in S2. So that's 32%. Clap for yourself. So that means the total indirect, the total H in S2, the total is going to be 60 what? 62, right?
62.
Right?
Yes.
So this is the total.
Yes, sir.
Total for H in S2, 62. Perfect. So your new group structure will look like this. H. You have your parent, H in X1, which is 80, and H in S2, which is what? 62. Please, who doesn't understand this analysis, please? Before I move on, I want to discuss two more principles. Number one is how to calculate purchase consideration. And number two is effective date of consolidation. So we need to discuss those two things.
Sir, please.
All right. So
Please.
I want your question before I move on. Please tell me any issue. Do you require further clarification?
Yes.
Before I move on? Tell
yes,
me. Ask Rebecca, me too.
30 and the 32%.
How we got that? Are you still on your bed as well, Rebecca, like me? Your voice sounds like someone that is still lying down. Anyway, this is an online class. It is allowed, right? How we got 30 and 32, right? Is that your question?
Yes, sir.
Okay. For 30% now, that is what H directly own in S2. Now, this is clear. This is 30%. What's H own in S2? Can you see it?
Yes, sir.
Okay, that's for that. Then the indirect acquisition, you have to go back to our previous explanations on subsidiary. Your indirect acquisition basically is 80%, which is what H own in X1. multiplied by 40. That is what S1 own in S2. That's 80 times what? 40. That is your indirect acquisition. So that's 80. Guys, I hope you are writing this thing down, please.
Yes, sir.
Hello, guys. Are you writing? Respond now. Respond.
Yes, sir. Yes, sir.
Hello. Okay. Thank God for that. Please write. Oh, this. All right. So, because as I'm just clearing all this thing. I'm deleting them immediately. Anyway, the video is there. You watch it again if you are confused anyway. All right. So that's how we got it now. So the 32% is your 80 on 80 multiplied by 40, right? So any other question on this before we move on to the next principle, how to calculate purchase consideration? Any other questions, please? Any other questions? So in the absence of no other question, let's move on to how to determine the purchase consideration. So let's go back. So let's now assume that here now for this H in X1 now, H, so I will clear all these things, guys, so that I want to explain purchase consideration. So I'll clear all this. So let's say H pay 400,000 for these shares. Then here H pay 180,000 for this. And here this guy pay 80, let's say 90,000. So how do we determine the purchase consideration? So for H in next one, for H, for the purchase consideration is clear now. For purchase consideration, for H in X1, it is very clear now. It's 400,000, right? That one, no wahala. But for H in S2, it is not so clear. The first one is, how much did we pay for the direct acquisition? How much did you pay for the direct acquisition?
180,000.
We pay 180. That one is clear. So who can determine how much is going to be the purchase consideration for the indirect acquisition? If whoever give me the answer when 1,000 naira, should it be data or credit? Let's make it credit. I'll send you person 1,000 naira credit. What is the indirect purchase consideration? Tell me.
I think that should be 32% of 90,000.
That's
Wrong.
57,600.
How did you arrive at 57,600?
That's 32% of the 180,000.
It is wrong, girl. It is wrong. You remember that the indirect acquisition is S2. You want to determine the purchase consideration from S2. Direct acquisition is 30%. This one is clear.
Okay.
Right? The indirect purchase consideration is that of S2. So this one is X1. The indirect is for S2. So how do we determine that? That is what I did.
That's 28,800.
of 28,800.
You guys are just calling different figure. Okay, hold on. Let's do some. Let's do something.
32% of 90,000.
It's not correct. Oh yeah.
Of 90,000, yes.
You know me. I'm very nice. I want to give you expo. X1. We own 80. 80%. S2. We own what? 30. Then X1 in S2. We own what? 40. So for this 40, we pay 90,000. So I'm now telling you, how much do you think will be the parents' purchase consideration? You know, this one, 30%, this one is gone already, 30% is gone. So tell me, how much out of this 90, how much will the parent contribute? I've given you further expo now.
72,000, sir.
72,000.
72,000.
72,000.
How did you arrive at 72?
80% of 90,000.
28,800.
No, the answer is 72, but I don't know who said it first. Talo Kokoso. I think I heard a guy's voice. I heard a guy spoke before you.
Yes.
Sincerely.
The guy.
No, I forced him. I forced him for 72 before he said it.
Who is the guy? Who is the guy that spoke?
The guy.
Speak.
I first. I said James.
Let me get your name.
James.
Let me get your name. Eh?
James.
James. Okay, James. I think you won. You won this card. I heard your voice first before Bello Yetunde. So what you do, James? Can you instantly just DM me on WhatsApp, please, so I can send you your credit? DM you with your network, MTN, Airtel, or whatever. I'll send you 1K credit now. You want that? Okay.
Okay, thank you, sir.
So now let's go back to class now. Let me explain
Sorry,
to.
Mr. Kazeem.
Yes, please.
You know, you said earlier that the share of the parents is like 80% times 40% of the S2. That was how we got the 32.
That is how to arrive at your indirect. That is how you arrive at your. Okay. Everybody calm down now. Let me explain now. Let me explain. Have we calmed down now? If you like, if there is a glass of coffee or water near you, just drink the water. Calm down. Drink water so that you. Okay, I'm receiving some WhatsApp message here. Let me check. Okay. Okay, so I have. Perfect. So I've received your number, so I will do the next after this class. Okay.
Okay, sir. Thank you, sir.
Yeah. All right, great. So for the indirect acquisition now, you are very correct that if you want to determine the percentage holding now, you do 80% of 40 AB. That is how you get. Well, if you want to know how many percent H own in S2, it is simply 80% of 40. But if you want to calculate purchase, remember that I told you that anything X1 is doing, H is entitled to how many percent? 80%. So if X1 want to do any investment, H will contribute 80% of the value of the investment to X1. So who will pay the balance 20%? You remember that this X1, H only owned 80%. H did not own 100% of X1. So the 20%, they are the NCI, non-controlling interest of X1, right? So in this case now, the purchase consideration that X1 want to pay to S2 is 90,000 naira. So H will only contribute his own share, which is 80% of 90,000 naira, while the balance of 20% will be contributed by the non-controlling interest of X1. So for the purchase consideration, you will take 80% of 90,000. So that is what H will contribute, which is 72,000, right? So H is only responsible for 72% of anything X1 is doing. That is why if you want to calculate the indirect holding, you will say 80% multiplied by 40 to know what is the indirect holding. But when it comes to contributions now, H will only contribute his own share, which is 80%. So I don't know. Is it clear to you guys now, please?
So, Mr. Kazeem, that 32% is just to know the percentage that H owns in S2, not for calculation of purchase consideration.
May God bless you. And if you are married, may your husband never run away. If you are not married, you'll meet your right husband. That is the correct answer to the question. You've just said it as it is. All right. So if you want to determine the percent, so that 32% is just for you to know the percentage holding. But whenever you want to calculate any contribution in form of purchase consideration, you are going to use what the parent directly own in the subsidiary. In this case now, X1 is an entity on its own, right? So, but H only own 80% of the entity. The balance of 20% is the NCI of X1. So that is how it works, correct? So that is exactly how it is.
Hey, sir.
So, yeah, great. So that is how to determine your purchase consideration. I don't know. Are you guys getting me? Can I move on to the last principle before we continue with the lecture notes?
Sorry, sir. Please hold
Yes.
on, sir.
Because most of the principles we are discussing now, you won't see them in any textbook. What you just see is question. But I need to bring out all these secrets for you guys so that when we are consolidating, there won't be problem. you will just be seeing solution, but you may not have this kind of analysis in details. That's why I'm spending time here. And the good news is this class is recorded. So when I'm done, you can still go and replay it again. At least I want you guys to be a master of these techniques I'm teaching you before next class, because next class is fire for fire. Once I resume by 7, question 1, we solve it. Question 2, that is how we'll be running. We'll be running at maybe about 120 kilometers per hour from next class. So I need you to do one thing. This class, please make sure you master it. Go through the lecture again, read it, understand before you come to class next class. Thank God that you can always rewatch it. I'll put it on YouTube shortly after this class. All right, question before I move on. Question, please. Dabira, you want to say something?
Sorry, sir. Can you please go back to the diagram?
I'm there now. I am
Hey,
there.
that direct acquisition, is it 30% of S1 or 30% of S2?
No, direct
Yes.
acquisition is what H own in S2 directly. See, 30%. This one on the right here, can you see how my mouse is moving?
Yes, but what you wrote was 30% in S1 is 180,000.
I am sorry. It's my bad. No verse here. Drink water here. Drink some water now. So I will calm now. Well, okay. Are we good now, everybody? I think somebody wanted to speak again. The ladies are the one,
sorry, Mr. Kazeem.
the guys are not speaking. It's like the guys are too brilliant, so they understand everything. But the ladies are asking me. Yeah, please ask me, please. My sister, I'm waiting.
Yes, sir. The 32% we got. What's it called? What's it called? What's the name?
Is it subsidiary or indirect holding?
Subsidiary of.
You
Sorry,
can say
finished.
indirect holding, indirect acquisition. That's 32%.
Okay, sir.
You understand, Abby?
Yes, I got that, sir. Thank you, sir.
Okay, so that is for that. All right. Any other further question? Last chance to ask question, or we'll move on to the next stage. It's 9 o'clock. Can I take this class at 9:30? Are you guys okay with 9:30?
Yes, sir.
Okay, okay. Let's take this into 9:30 then. All right. Okay, no question again. Let's continue. So effective date of consolidation now, that's the next principle that I want to explain to you in 5 minutes. Effective date. So this is the date. I'm sure you know what is a sub-subsidiary now, right, everybody? You know the meaning of a sub-subsidiary. Sub-subsidiary or indirect.
Yes, sir.
Subsidiary come under the control of the parent. It is either of the following. It is either of the following. Okay. A, the date the parent acquire interest in subsidiary if the date the parents acquire interest in subsidiary, the date the parents acquired interest in the subsidiary if the subsidiary already owned investment in subsidiary. Now look at this case now. Look at this case. Let's say H in X1, it was acquired on 31st of December 2022. Then we have S1 in S2, 31st December 2021. So who can tell me the date that H we use in consolidating S2? What date do you think the H we use in consolidating S2 as a subsidiary? As a sub-subsidiary. So what date do you think H we use in consolidating S2?
The date he acquired S1.
Why not use the date X1 acquired S2?
Because H was not like involved before that time.
Perfect. You are correct. So in this case now, H only owns S1 in 2022, whereas X1 already owns S2 in 2021. So if you want to consolidate H in S2 now, it will surely be 31st December 2022. You cannot use 2021 because in 2021 there was no H. And guess what? ICANN will give you reserve of S2. They will give you for 2001, 21, and 2022. So you'll be confused. So if you pick the wrong one, your solution will be wrong. So you must properly determine the right effective date of what? Consolidation. So let me give you another instance now. We have H in X1, 38th of June, 2022. X1 in S2, 31st of May, 2020. So what date will I use for H in S2, please, everybody? Hmm?
30th June 2022.
30th of June. Perfect. You cannot use 2020 because there was no S1. S1 in 2020, right? So let's take the second principle. Number 2, the date. Number 2, this is the second principle. Second principle, the date the subsidiary acquired investment in S2 if X1 already, if the date the subsidiary acquired investment in S2 if H already owned investment in X1. So let's see. No, the date the subsidiary acquired in, let me call it subsidiary, right? If H means parents already own investment in subsidiary. So look at this principle now. We have H in X1. H in X1, 38th of June, 2014. Okay, X1 in S2. X1 in S2, we have 31st of December, 2015. So what date will H using for X1 here? What date will H use to consolidate X1, everybody? What date will H use to consolidate S2? S2, sorry, S2, H in S2. What date will H use to
31st
consolidate?
12 2015. I
Why
don't
not
know.
2014?
Because he already acquired, like, he's already involved in the process of S before the acquisition of S2.
The correct answer is there was no S2 in 2014, right? You only acquired
Okay.
S2 in 2015. So
15.
this is exactly what I refer to as effective date. So you must properly know this date because ICANN will give you the reserve of S2 for both dates. So you need to carefully determine which one is the correct reserves to use. All right. So are we okay with this now? So these are some of the techniques that I need to explain to you guys so that you understand these things very well. So let's go back to the notes. So we are done with the analysis of the various types of subsidiaries. So let's discuss reserves now. Let's discuss reserve. So there are two types of reserve in group accounts, right? The first one is the pre-acquisition reserve. I'm sure you know all these things before from your skills level, but let me just brush through them. Let me brush through them fast. So the first one is your pre-acquisition reserve, and the second one is your post-acquisition reserve. So what is pre-acquisition reserve? Pre-acquisition reserve, these are the reserve that exist in the book of the subsidiary at the date of what? Acquisition. So any reserve that exists in the book of the subsidiary at the date of acquisitions, they are known as your pre-acquisition reserve. Please note that your pre-acquisition reserve should not be consolidated, but you use your pre-acquisition reserve in computing your goodwill. You don't consolidate this, but it is only relevant for goodwill computation. So that is what pre-acquisition reserve is all about. You use your pre-acquisition reserve to calculate goodwill. You don't use your pre-acquisition reserve to consolidate. It is basically for goodwill computation. So that is exactly what pre-acquisition reserve is all about. Okay, so that's for pre-acquisition reserve. Then the second one is post-acquisition reserve. Post-acquisition reserve. Post-acquisition reserve. So for post-acquisition reserve, these are the reserve generated subsequently to the date of acquisition. So they are the reserve generated by the company subsequently to the date of acquisition. And this kind of reserve should be recognized in P&L. You should not capitalize it. So any post-acquisition reserve should be recognized in your P&L. Okay, it is only pre-acquisition reserve that you use in goodwill computation, whereas your post-acquisition reserve should be recognized in your profit or loss. So that is how you treat your post-acquisition reserve. So your total reserve basically is your pre-acquisition reserve plus post-acquisition reserve. So in most instances, you will be given pre-acquisition reserve and total reserve. So for you to calculate your post-acquisition reserve, you need to subtract your pre-acquisition reserve from your total reserve for you to determine your post-acquisition reserve. So that's just what the reserves is all about. So the next one is a non-controlling interest. So for non-controlling interest, like you are taught in your skill, it's still the same here. There are two methods of computing your NCI. The first one is a proportionate share of the net asset method. Okay. The second one is fair value or full goodwill method. These are the two methods. Okay. Proportionate share of the net asset method is the first one. Then the second method is the fair value or full goodwill method. Now, note that before you can use the second method, the fair value or full goodwill method for your NCI, they have to give you the market share of the subsidiary, okay, or the value of the NCI itself, or they give you the fair value of the NCI itself. Either you are given a fair value of the NCI itself, or they give you the market price per shares of the subsidiary. So those two must be given for you to be able to determine for you to be able to use your full goodwill method. So if any of those things are not given, you can't use your full goodwill method. All right. So in the exam, the examiner will always be specific on whether you should value NCI at proportionate share of the net asset method, or you should use fair value or full goodwill method. The examiner will always be specific, and please always follow the examiner's instruction. Sometimes you'll be given the fair value of NCI, you'll be given the fair value, but the examiner will insist that you should use proportionate share. So don't go and do over sabi and use the wrong method. You must always follow the instructions, right? So we're going to solve questions using both methods, both the fair value or proportionate. We are going to solve a lot of questions. So let's move on now. Goodwill. What is goodwill? So goodwill is the excess of the amount, is the excess of fair value, excess of the purchase consideration over the net asset acquired. That is your goodwill. So if your purchase consideration is 100 and the net asset you acquired from the subsidiary is about 90, so the excess of 10 is your goodwill, and you must account for your goodwill. Okay, according to IFRS 3, the goodwill on acquisition must be capitalized and subject to annual impairment. You capitalize your goodwill and subject it to annual impairment. So for annual impairment now, we need to be careful here too. Okay, how you treat your impairment depends on the method that you use for NCI computation. Okay, how you treat impairment of goodwill depends on the method that you use for NCI computations. For example, if your NCI is valued at proportionate share of net asset method, that is, if you are valuing your NCI at proportionate share of net asset method, you just you debit the entire amount of impairment to your reserve and credit your goodwill, please. If your NCI is valued at the proportionate share of net asset method, you have to debit your reserve. Okay, you debit your reserve with the entire amount of goodwill and of impairment and credit your goodwill. However, if your NCI is valued, please take note of this. So take note, take note, take note. I mentioned it 3 times because I know students mix it a lot. If your NCI is valued at fair value or full goodwill method, then your impairment must be borne by both the group and NCI. So that means you have to prorate your impairment into your reserve and NCI based on the percentage of shareholding. You share it. If it is 80%, that means 80% goes to reserve and 20% goes to NCI. Then you credit your goodwill. Please take note of this principle. I repeat it again. It's very important. I will remind you when we are solving question next week in the class, so that I said this. Okay, so you can see how it is done here. So that is it. So in this case now, there is an impairment of 4,000. So the impairment was just share 3,000 to the reserve and 1,000 to NCI based on the percentage of shareholding. Then you credit your goodwill with the entire impairment. All right. So the next one is gain on bargain purchase. What is gain on bargain purchase now? So, goodwill is when the purchase consideration is more than the net asset acquired, right? But gain on bargain purchase is the opposite. When the net asset acquired is more than the purchase consideration. You paid 80 million naira for a company and the net asset of the company is 90. So in that case, there is a gain on bargain purchase. So there is a gain here. So the question is, how do you now treat gain on bargain purchase? The standard state that for gain on bargain purchase, you must recognize it in your reserve immediately. Okay, you must recognize it in your reserve. You don't capitalize it. So any gain on bargain purchase should be recognized immediately in P&L or your reserve straight away. That is exactly what you do to gain on bargain purchase. Now let's look at the purchase consideration and form. I think I'm almost done here. Purchase consideration and form. So there are various types of purchase consideration in group. We have what is known as the instant payment, right? Instant payment is involved when you are making an instant payment. The purchase consideration is 80 and you are paying the 80 million immediately. So under instant payment now, the purchase consideration will always reflect in your non-current assets based using the actual amount paid. So this one is very straightforward, but the complexities are with these two. Everything I'm saying here, we're going to solve questions, so you understand. I'm just trying to explain. When we are solving the case studies, you understand better in the classroom. So instant payment is when you are making an instant payment, right, for the acquisition of the subsidiary. That's what is referred to as instant payment. Then for contingent now, this contingent consideration now is when your future payment depends on certain conditions. You have to give a conditions before you make that additional payment. Let's say you promise that, okay, the company purchase consideration is 100 million, but you will pay about 80 million now. You now promise them the balance of 20 million will be paid so that so there's always a condition if. So if they meet up with the condition, you pay. If they don't meet up, you won't pay. But according to IFRS 3, you must recognize your contingent consideration at the fair value, okay, on the date of acquisition. That your contingent consideration, you must recognize it at the fair value at the date of what? Acquisition. So that's what the standard states. Right. The next one is a deferred consideration. So for deferred consideration now, there is no condition attached to deferred consideration. The amount will be paid at a future date. Okay, you have to pay it. So the standard says that you should always discount your deferred consideration to its present value using the applicable cost of capital, which is very similar to the contingent. So both deferred and contingent are similar. So when we solve the questions, you will understand the treatment. So you have to discount this ones too at present value. Okay, so that's the difference between the two. All right, so let me move on to expenses and issue costs. So what the standard says is that any expenses such as the lawyer fee, accountant fee, you have to write them off, okay, as they occur. However, any share related expenses must be deducted from your share premium account. Okay, your share related expenses should be deducted from your share premium account, while every other expenses and issue cost should be written off to P&L. However, share related expenses should be deducted from your share premium account. So that's just it. So every other adjustment, we will discuss them in the class. So when we meet next week, Saturday, physical, we will start with the case studies. So I will still plead with you guys. In fact, this is not it. Okay. Let me stop recording. Any questions for me? Let me stop recording. We've done a whole lot on group structure, even. So let me stop recording now so that I don't keep the length.